The White House has just released the president's 2019 economic report earlier today. We welcome now Kevin Hassett, chairman of the Council of Economic Advisors, to take us through the highlights. He is today's conversation in chief, and he comes to us from the White House. So welcome, Dr. Hassett. Great to have you here as always.
Oh, yeah, thanks for having me here, and please always call me Kevin.
Okay, I shall, Kevin. Fair enough. Fair enough.
I'll call you Dave.
Okay.
But so it's the 73rd economic report of the president going back to 1946. And, our job at CEA is to describe the state of the economy and to go through policy opportunities and policy challenges and help people make rational decisions that are really embedded in the economics literature. And so we have a 700-page book out there that's got plenty of nerdiness for all of your viewers who really want to dig into the issues.
Well, I haven't gone through all 700 pages, but I've gone through some of it, certainly. Tell us what the high points are. What's the most important thing for the American people, for that matter, for Wall Street, to understand in this report?
Well, I think that the really big news in the report for us is just how well the economy is serving people at the bottom right now. And so, the most recent people who were hired, 73% of them came from out of the labor force. A lot of people said they were gone forever from the labor force. Another thing that happened is that wage growth has started to take off. The bottom decile wage growth is up to 6.5%, and 5 million people are off of food stamps. Even, veteran homelessness is down 50%. Now, it's not just our policies that are doing that. The fact is that we've got a recovery that's long in the tooth and it's accelerating, and that's just the sweet spot for the American worker. And I think that's really the headline of the report, is that the state of the economy is strong, and it's especially serving well those who most need it.
Yeah, certainly the job market has been strong, remarkably strong in many ways. At the same time, you said it continues to move strongly. What are you projecting? Because you're projecting, on average, as I understand it, 3.0% growth over the next 10 years. A lot of economists, in fact, the consensus of economists overwhelmingly is we're not going to do that this year.
Right, and that's what they said last year, and I think you and I were probably talking about it about a year ago, and people are saying, oh, well, CEA is saying you're going to have a 3.1% year. That seems pretty high compared to blue chip and so on, and I think the fact is that we're a lot more optimistic about the impact of our policies than a lot of folks that are relying on a much older literature, and I think that the evidence last year was very consistent with what we said would happen. A 9% cut in the cost of capital, we said that'd lift investment 9%. We nailed it. It was about 9%. We said GDP growth would be 3.1. Once that happened, we nailed it. It's 3.1. We said low-income wage growth would go up because the capital would increase productivity and that drive wages up. We nailed that one as well. And so I think that our understanding of how the economy works, which is grounded in a whole surge of peer-reviewed literature in the last few years, identifying the impact of policy on the economy, that it's a very sound understanding, and it suggests that the boom is going to continue, at least for a few more years, up in the threes.
Kevin, what about the numbers that are coming right now? We're almost a quarter of the way into the year. You have the Atlanta Fed GDP now numbers coming in at 0.4% for the first quarter. Do you just disbelieve those numbers, or do you think you can dig yourself out of that hole?
No, I think that there's something that economists call residual seasonality. I mean, oh gosh, 100 people just turned the TV off, right? But first quarter keeps being weak, and the first quarter keeps being weak year after year after year. I think a typical first quarter now is about 1%. A typical second quarter is about 3%, and we're looking for that pattern to be in the data as well. And if you go back and look at what was going on with equity markets and sentiment at the end of last year and compare it to what's going on now, then you can see that the kind of stuff that you would need to see in sentiment and in markets to suggest that you're going to go back to 3%. It's visible right now in markets. But you're right that the data for the first quarter are looking pretty weak. Do you think the slack is leaving the labor market? If you just look at the one data point of the last jobs numbers, we were disappointed with 20,000 jobs added. At the same time, wages were up substantially. Do you think that's an early indicator, maybe, that we're running out of people to add to the workforce and we may have inflation around the corner, at least in terms of wages? No, absolutely not, because so many people are coming off the sidelines. Again, 73% of people came from out of the sidelines to having a job rather than from unemployed to having a job. And so we're drawing people back in droves because wages are going up so much, and wages are going up so much because we had the capital spending boom that we expected, and that's driven productivity up. And so if productivity is higher, then wages can go higher and it's not inflationary. If we just basically have a labor shortage and then we start bidding for workers and driving up the wages without any kind of enhancement to productivity, then that can be inflationary. And so right now, what we're seeing is really a sweet spot for the economy because of the capital spending surge that started last year.
So Kevin, let's talk about trade. I'm not going to try to take Ambassador Lighthizer job away from him. You're the economic advisor.
No kidding.
But on the
really
economy, On the economy, I mean, you're a trained economist. You have a PhD in economics. I have much, much less than that, but I've taken some economics. One of the first things you learn is that basically there is a direct relationship between fiscal deficit on the one hand and trade deficit on the other. Who gets the lucky job of telling the President of the United States that, in fact, we're going to have a substantial trade deficit as long as we have a substantial fiscal deficit?
Well, I think that the president absolutely understands that. You know, that I was with the president yesterday, talked about the economic report. I won't talk about everything that we talked about, but he understands, you know, economics and he understands the links between these things. But I think that his focus since he's been there from day one has been to fix the asymmetries in the trade deals. And so the fact is that the tariffs that other guys have on our stuff are way higher than the tariffs that we have on their stuff on average. You know, and I think it's something like 80% of products face a higher tariff from our trading partner than we place on it, and the president wants to level that playing field. And I think that you can see from all of the momentum that we've got with the China deal and with USMCA and with the talks with Europe and so on, that he is getting trade reform that other people thought was impossible. And if that trade reform happens, then that's a big positive for growth. And if you go back to last year's economic report of the president, it was probably somewhat controversial at the time. We said the president's objective is trade reform, and we used an OECD model to show you what would happen to growth if we got it. And you know, we're still on track to think that that's what the trade effect is going to be on net going over the next 10 years. So,
Kevin, I apologize. I'm going to break format here just for a moment because we had a viewer actually write in and ask a question that I'd like to actually hear the answer to, which is if the administration is doing that great, how come we have to be borrowing $1 trillion per year? If we're really doing that well, we'd be paying down the deficit rather than running it up. What is the answer to that?
Right. Well, I think that, you know, the president came into office with the priority of ending the fact that we were the highest corporate tax place on earth, so there are no new factories here. And he also had to fix a problem that we saw in defense. Like, you remember there was this hurricane that took out a bunch of fighter planes because they were stuck on the ground. They didn't have spare parts. And so there was some military spending that had to happen as well. But he's, you know, gotten us ahead of the curve on those issues, and we've got a heck of a lot more economic growth. And so think about it this way. Since the president arrived, and I arrived shortly thereafter, the CBO's cumulative GDP forecast for the next 10 years has gone up by $7 trillion. Actually, it's more than that. And the deficit forecast has gone up by about $1 trillion. And so, like, that's a trade that any rational person should be willing to take. And the $7 trillion gives us, you know, lots of wherewithal to deal with the deficit problem moving forward.
And finally, on the subject of jobs, I want to bring up somebody you and I both knew in different capacities, and that's Alan Krueger, the economist from Princeton, formerly had a job at the White House, as you know. But on the specific subject of jobs, one of the things we talked with him about and that he wrote about was the structure of the labor market. And I'll have a quote here from one of the papers that you know. I think it is more appropriate to model the labor market as imperfectly competitive, subject to monopsony-like effects. That's, of course, sort of monopoly power from the buyer's point of view. Is this an issue that the administration is concerned about? Some of the things that could be done in concentration or some of the restrictive covenants that may actually suppress wage growth? Because I know President Trump is dedicated to higher wages.
Yeah, absolutely. And, you know, we're all heartbroken at the CEA about Alan Krueger's passing. It happened way too early. He's a great economist, a great man, an incredibly generous colleague. And, you know, I first met him in grad school, and I just watched his career take off, and I was humbled by the fact that he just could accomplish so much. I think that paper that you're talking about with Alan has got a lot of food for thought in it, and I think that restrictive covenants have skyrocketed in the economy, and that it's something that we're actually studying right now at the White House very seriously, because there's a lot of, you know, food for thought in his work that suggests that these restrictive covenants are creating a monopsony power that could have an impact on wages. Now, it's probably, you know, maybe much less than half of workers that have those restrictive covenants, and that's one reason why the wages have gone up so much. And we you know, right now are looking into the fact that maybe it's possible that the restrictive covenant space is a place where wage growth is a lot lower still. And so we've taken that paper very seriously, and it's something that we're really digging into right now.